Ladies and gentlemen of the crypto space, we are live on a Monday, September 11th at 11:35 a.m. Of all days, we'll look at the technicals, we'll inspect ways to navigate this market, and most important, the topic of the day is to inspect your runway. Runway is a terminology that's used very traditionally from a startup perspective or an enterprise perspective, is how much capital is available to continue financing OPEX requirements. And OPEX obviously includes human resources or resource in general, like supplies and materials, those types of requirements. So what I like to do is think like that. What the hell is the difference between an enterprise and us? It's basically the same thing. We are essentially an enterprise. And that, to me, allows us to have a bit of context of how we should operate to better ourselves by operating as a business. So, do you have enough OPEX capacity to last how long? Maybe from a less sophisticated perspective, one would call this savings. But I choose to label terminologies differently that give it a different flavor, allow us to tell a different story, and allows us to have a different perspective on the way we manage capital. And and and, and that's a good thing. Why? Because the vast majority of persons talk about capital and money and dollars a certain way, but by defining things differently and talking about things with different terminologies and different context, it gives us a different perspective. Therefore, we're able to be different. We're able to operate differently. And that's one of the core tenets of the things I want to push for myself, as well as I like to talk about and encourage other people to do, is to think different, to operate differently. So technicals look pretty poor this morning, albeit from a dollar perspective. As always, we're at a crossroads. So yesterday was an interesting event in my mind. We heard about the outcome of the G20 talks, and that's very promising from a rational time horizon perspective. If the G20 wants to do any of the things that they're talking about, um, you can't finance it from fiscal because then you literally have the doom loop that everyone's been talking about. If tax receipts continue to decline and you're financing all those initiatives using fiscal, um, you just have more debt to service more debt, and it just is compounded. So logically, to execute from an international perspective on such a large multinational set of goals, um, you need tax revenue across all of those sovereign nations. And in order for that tax revenue to be there, um, you're not having a recession. It doesn't work like that. The tax revenue declining in 2024, we're heading further and further into doom loop territory. I mean, the amount of sovereign national debt that needs to roll over in 2024 in the United States is extraordinary. So, as it is, the $7.8 trillion that needs to be refinanced, it's going to be all fresh on the run Treasury issuance at a significantly higher rate. I think the numbers put it at $1 to $1.3 trillion per year by the end of 2024. So if we have a recession next year and it's higher than that because the tax gap is that much more and that much less tax revenue is received, it doesn't make sense. They have big talks going on that are involving large capex from a nation state perspective. So how do you finance that? So this is obviously a contradiction from the prevailing direction that we see in technical indicators. And that means to me crossroads written all over it. And I like to think from or what likely can happen with regard to like a credit crisis and just the drying up of liquidity and the forced selling, which causes asset price depreciation. And this all makes sense. We must rationally accept that this is the cards that have been dealt. This is what's on the table to be considered. But that is a complete contradiction to everything that wants to be achieved and all of the government plans that are being talked about. And that strikes me as something to think about. Like, what are they doing? Why are they doing it? And that's part of the equation, especially nowadays, especially post '08. Isn't that almost all of the equation? What are they doing? And how are they going to do it, considering all of these macroeconomic forces in play? They ain't going to do shit if there's a ridiculous recession. Dare we talk about an organically resolved recession? Organically? I don't see any potential for any recession to come that will be organically resolved. That you're talking about way pre '08 type of markets that take a decade to regain any type of nominal pricing, yet alone inflation adjusted pricing. So that doesn't make any sense to me. So, I don't write off anything, but that seems like it's a low potentiality. Um, we see time and time again interventionism. So in my mind, I'm leaning mostly to not the gross, ridiculous interventionism that occurred in 2020, where fiscal deployed capital to the general public. I'm pretty sure they have discounted the significance or the effectiveness of the MMT type arguments, but to some degree they will have to finance social civility. But I don't think they're going to be as stupid as they were as in 2020. That was like distress and they were just panicking. And of course, government has the potential to panic in the future, but I'm inclined to think that they will be at least better than worse, better than the last time, even a little bit. So what does that mean to me? It means the likelihood if we have systemic instability in the real economy, it means social civility gets financed, but it's going to be financed in a better way than the last time because the last time really fucked everything up. And the majority of interventionism will be with regard to the financial economy because you don't have a real economy if you don't have a financial economy. So if the financial economy just, if productivity and tax receipts completely come down in the financial economy, they're not financing shit. So the real economy needs to be contained. And, that's like wage growth. And I don't see them giving out stimmy checks like they did. That was a big mistake, and arguably that wasn't the entire cause of the consumer price inflation we've seen over the last couple of years. Obviously, the supply side of the equation, but it has to be the case that that type of capital infusion surely affected consumer price inflation levels. So be more controlled and provide different facilities and at least be a little bit more rational because what is their goal? What is their intent? Their intent is to make sure consumer price inflation is relatively controlled, to make sure social civility is maintained, and they need tax receipts. So, okay, you're not necessarily going to get these tax receipts from growth in the real economy. You obviously could get these tax receipts from growth in the financial economy. So to me, it makes sense that a fair amount of stimulus could be applied to the financial economy at some point, and it'll be reactionary with regard to the amount of tax receipts that occur probably in Q1, Q2, maybe even into Q3 of 2024. So notice the time horizons I'm talking about. So that's the time horizons that must be considered with regard to runway. You need to have enough capital on the sidelines in whatever cash denomination that you feel most comfortable with. It's comfort. You have to be able to pass the time. So please adjust your cash position accordingly. You have to pass the time until monetary and fiscal policy are required to adjust the trajectory of economic functionality in both the real and financial economy to accommodate the tax receipts in order to accommodate uh, international agreed upon goals and objectives. So all of these thoughts came to me as a result of literally what they were talking about at the G20. And that's some crazy international, like multinational plans. And then that was quite interesting to see. You know, you're not having a decade-long global recession having those kinds of conversations. That doesn't make any sense. You know, if the Great Reset occurred in '08 and everything was reset to zero, post '08 is has been an exercise in creating a globally managed liquidity environment. I mean, that's everything they've done, including in 2023. All the liquidity disruptions that could have occurred from bank balance sheet issues within the United States has been managed. Why would they do that? Because if there's a significant disruption of liquidity, the entire system falls apart. And I don't think they have a capacity to resuscitate the system at this point. So they really they didn't have a capacity to resuscitate the system in '08. Just the total amount of dollar liabilities in circulation, if that started to cascade, he's talking about printing like 100 trillion US dollars, not $10 trillion, M0 type dollars, like real dollars. So you can only imagine, and that's what we're doing in this mental exercise, is we're speculating on the types of conversations that these global actors have to consider. I don't think they could allow, you talk about like global dollar liabilities, but that's really like a regime, the global dollar regime. That's the vast majority of dollars in existence. So I don't think they could even potentially consider that destabilizing and starting to liquidate and cascade, so on and so forth. So that means there needs to be a certain amount of activity such that cash flow can finance any debt servicing obligations that are associated with the aggregate global dollar regime, which isn't in the United States. So what does that mean? That means, in my mind, over a decent time horizon, the dollar has to come down as a result of collusion. And that's why these daily charts are going to drive you freaking nuts. They're going to drive you nuts. These weekly charts, they're interesting and it's meaningful, and I would love to see this 50 SMA on the weekly break to the downside, because there is not necessarily any upside left from this monthly chart perspective. And look at that Stoke RSI is completely bottomed out on the monthly, and we just pushed the monthly TWAP as resistance. So this is why it's precarious times and you need some serious runway. Adjust that cash position. But 2024, they're going to have to do something, because this directionality, the direction the system is heading, is not sustainable. Not sustainable, and what does that mean? That means cascading social incivility. People start fucking going nuts. Economies start to fail. You get post-apocalyptic type scenarios where people don't have food and they're murdering people for food or robbing for food. And that's exactly what we see, obviously, in social media to a degree. And I don't think countries want that. I don't think people want that. I don't think they want to see riots and all of that type of social unrest. So, finance social civility. And that's the conversation we just had for the last 15 minutes, is the potential ways they finance social civility in somewhat of a sustainable way, such that it actually maintains the system's functionality, maintains the integrity of the system, and puts the system in a different trajectory. The directionality changes. Right now, the directionality is clear. It's heading towards systemic failure. And this is why they talk about soft landing, because that failure is the plane coming down, and a hard landing is where it crashes, and you have gross liquidations, cascading, capital destruction, and that's the hard landing. That's what it means if you break it down. So a soft landing is we kind of just grind along with this bleeding capital loss of forced selling, and then the equities markets kind of just muddle along. You get a little malaise with regard to revenues from a traditional equity standpoint, and then comes the positive financial encouragements like loosening monetary policy, which boosts credit, which boosts liquidity, or financial incentives like tax incentives or stimulus. And where that stimulus heads affects what's going to play out. And I don't see that stimulus from a fiscal perspective heading to the real economy. My expectation, my base case, is a fair amount of stimulus into the financial economy. One, most certainly, is to maintain the integrity of the international global dollar regime, which isn't created or managed by the United States, which means foreign fiat needs to be price adjusted to the upside. How do you come out of a G20 conference with those kinds of goals in mind if foreign fiat is continuing to depreciate over the next decade? Like we break to higher highs, we're at 120 heading towards 140, 50, and 60. That's how you further abandon allies. That's how you further create divide in the international order. I mean, look, China and Russia already didn't show up to the G20. If dollar was at 120, 140 next year, how many countries aren't showing up to the G20? There'll be a G10 at that point. So for that kind of conversation to have been had, you're talking about like a secular trend reversal in the dollar where foreign fiat is allowed to reprice upward and international countries actually have tax receipts, have a functioning economy, and are able to purchase and have purchasing power in dollar-denominated goods and services. And that's where this 6-month perspective is quite interesting. And that's basically like a change of the order because we've had a dollar bull market since 2008. Look, higher lows, higher highs since '08. There's a low here in January 18. Retest back in 14. Higher low back in 11. Double bottom in 21. And then the most ridiculous shooting star in decades in July of 22. 6 months. So it says 2H, second half of 22, heading into the end of the year. So you might have continued depreciation and volatility, putting forced selling, sell pressure in general on assets that can be liquidated. But over the next 6 months, I mean, look, we're already one candle post H2 2022. So we've already gone past, first half 2023. So you're talking about, from a technical perspective, by the end of the year, this is a very interesting candle, and this candle and the next candle. So there's literally two candles between now and H2 2024. It's the end of this year for the close on this candle, and the next candle is the first half of 2024. And we get to see. Maybe it doesn't get above a double top at 105.821. Maybe towards the end of the year, we actually get a lower low. So if we close on the DXY below 102.910 in December 31st, 2023, that'd be very interesting from a technical perspective and very supportive of this directionality change as expressed in this chart. We have one candle that produced a lower low, and then we would have a second candle, and that's what we call confluence of directionality. Maybe it closes where it opened, 102 and change, and you have like a spinning top, which introduces the reality of uncertainty. Is there upward pressure or downward pressure? In which case, you look for the next candle for confluence that either confirms or invalidates thoughts on directionality. I don't see how this doesn't come down. And I understand the amount of debt, the global debt, 350 trillion in debt servicing obligations to manage that amount of dollar currency in circulation globally. But this isn't a chart that's based on organic. Well, yes, obviously the appreciation is organic, but these downward trajectories, even in the 2000s, aren't an organic phenomenon. It's not like all of a sudden it doesn't make sense for this to go down. The amount of debt that's borrowed, the amount of demand from a dollar FX perspective just goes up, up, and up, considering the amount of dollar liabilities that are created in circulation. So that is my thought of what occurred in 2020. And guess what? I think that's this candle. They deleveraged the shit out of the global dollar regime, which they have no control over. So the only thing they could do is print 10 trill and deleverage it. That's an interesting tweet that I talked about earlier this week, where a very popular argument is that they debase the currency, and sure, that is true. If you're increasing the amount of supply, they're debasing it. But they say they increased circulating supply, and I said that 2020 was an exercise of deleveraging, because those dollars that people like to attach stories to, that they printed, it was already printed decades ago. Already printed decades ago. So if you have this amount of liabilities in circulation, and this is the money used to create those liabilities, and they increase the amount of liabilities, that's deleverage. It's like adding more collateral to the system. Just like you topped up your Aave collateral. You got a, $10,000 loan on Aave using 15 ETH, 20 ETH, and all right, let me throw in another 5 ETH. That's what 2020 was. Let's throw in a little bit more into our collateral pool, so we bring down or bring up our health ratio. And that's really my take over the last couple of years. So the last couple of years since 2020 was, in my mind, a strategic plan to deleverage the global currency regime, take pressure off the system. Now, bear in mind that also implies what's to come in the next cycle. There's a significant increase in global liquidity, which is very consistent with the conversation that was had at the G20. How the hell are you going to finance any of this shit unless you have crazy liquidity in the coming years? When I say coming years, you're talking about like the next 5-10 years heading into 2030. Got to bump up those time horizons. People are playing with those rookie numbers. So, I mean, come on. They printed $1.8 trillion fresh on the run collateral, and they got to roll over $7.8 trillion next year. Come on. They're going to print more next year aside from rollovers. There's going to be 10 trillion worth of fresh on the run collateral. One, who's going to buy it? Two, it's fresh collateral. What do you do with this shit? You print dollars. I mean, that's the whole point. That's what the whole system is. You take treasuries and you print dollars. That's what it has been. It's what it will continue to be. And what does printing of dollars do? It increases global liquidity, which drives GDP, which drives tax receipts, which drives productivity, GDP. And what does it do to pricing? You get the disparity, the divergence between asset prices and income from salary. So salary income just goes slow as shit. You're never able to catch up, but asset prices keep going to the moon. And what do you see? People say hyperinflation, or when they see the hockey stick in the charts with regard to asset prices. But if everyone's hyperinflating simultaneously, that's why FX gives a very complicated presentation. If the United States and the ECB increase money supply 10%, what does that do to FX? They both increase money supply 10%. So FX is relative pricing of the currency. So you could have a great deal of global collusion to allow for a significant increase in the money supply without significant price issues occurring at the FX level. You get hyperinflation when one currency increases the money supply significantly more than another currency. For instance, Argentina. Their currency supply significantly increased as compared to the United States. So their price went down. But if the United States did the exact same thing, the FX, the foreign exchange pricing, I don't see how it would be significantly volatile. Same pricing, same quantity of currency supply change. Now, bear in mind, have you seen the charts with regard to like Chinese money supply increase over the last decade or so? That's extraordinary. So it makes the United States look very fiscally prudent with regard to debt issuance and what Treasury does with regard to the base money at the M0 level. So that's going to be interesting. And that also, in the international market, that depreciates their value and also the value of their currency and puts upward appreciation on our dollar value. So as other countries, especially from a G20 perspective, the closest of the close allies, at some point the U.S. is going to have to intervene and devalue the currency. And I don't think they're going to come out and say, hi, I'm devaluing our currency. No, but what they're going to do is the collusion, FX arbitrage, such that the allies and the close allies of this nation, we don't destroy their currency. So they continue to have productivity. And why do we want them to have productivity? Because we need their supplies and their natural resources. And in order for us to have access to that, to be able to buy that, they actually need a functioning frickin' economy. We're not in the business of collapsing nations that are supplying us with needed goods and services. Unless we could find an alternative, which is obviously what has been playing out with China. We're not fond of what's going on over there. So, even more so, maybe that bolsters my argument even more. If we're moving away from China, China didn't come to the G20. If we're moving away from that, holy shit, do we need significant productive capacity in other nations, which means it's even more inclined for this chart to come significantly down. Over what time horizon? Check back, 2026, 2030. Got to wait years for these types of celestial scale phenomena to play out. Celestial, it takes a long time for these massive systems to move. It's bigger than the mental imagery of like a super tanker making moves. You're talking about like how long does it take for the sun to become go red or whatever, red dwarf, red giant. You're talking a billion years. So these are celestial phenomena. Check back by 2030. So my expectation over the next 15 years, we see the dollar come down significantly. And that's how this entire game from an FX perspective actually works. I'm not going to repeat over and over again the arguments earlier, but none of it works of what they talked about at the G20 if this keeps going up. It only works if this comes down. So if this doesn't come down, why the fuck did they have those arguments? Why did they have those conversations? Doesn't make any sense. Osarko's in the house. Sir Joe H. Diz Tap C. Joining a bit late. Yeah, what am I doing? I'm inspecting. I'm finding comfort. I'm defining time horizons. I'm determining runway, how much capital I need to continue what I'm doing. Finance expenses, meet expectations in 2024. My expectations do not exceed what is reasonable. That's the most important thing, because that's how you're able to allow time to pass and not be disappointed. Set reasonable expectations. Tapsy, I thought 5.5 was a good entry on CVX. Oh boy, sold liquid assets a while ago, so there's enough cash. That's something at least. I took a convex position. It was a good size. It was a size I was looking to attain. It's depreciate a little bit. It's not a tremendous amount. My expectation is everything continues to depreciate. My expectation is cash flow continues. I expect cash flow to come down. I find myself in a comfortable position because I already have enough capital to execute on 2024. In both speculated to depreciate cash denominations, be it Bitcoin or Ethereum, predominantly Ethereum currently. So if that Ethereum depreciates 10, 20, 30, 40%, oh my God, one, that'd be freaking wild. And two, I'm still able to finance my 2024 expectations. Uh, and man, all I know is all this volatility, appreciation and depreciation, you know, I just want to see it. And that's the most important thing, at least to me. And my goal isn't necessarily just to experience depreciation. I want to own these assets and watch what they do because I find them fascinating. So I want to see the depreciation. That doesn't make any sense. I want to experience depreciation. That doesn't make any sense. But I need to be here. And that makes me happy. I love talking to you guys. I love having these conversations about cash position composition, and probably adjust the cash position a little bit, maybe take some off the table from an Ethereum to a USDC position. I don't really need it though. So why not just retain the Ethereum position? Because I do have a target quantity of Ethereum I want to have. It's irrespective of price. I want a quantity of Ethereum, and for me that target's really about 32. So I'm not too fond of readjusting because I know the cash position is just going to increase over the next 6 months to a year. So why do I need to adjust when overall cash composition is going to automatically rebalance as cash flow continues from employment as well as from cash flow that I receive from the assets that I own. Looking at the balance over there. So I don't know. Hope that helps. I'm not in the business of telling people they should lose money, but so many folks are so sensitive to losing valuation of a portfolio, and to me, that screams the contrarian perspective is needed. Why? What's with the emotion? What is the point? What is your goal? If everyone's goal is to just make as much money as possible, that seems like a shitty fucking system. And I don't want to subscribe to the HODL mentality because that seems like a crowded mentality. So what I tried to do for you guys is to define it more granularly. That's why we talk about cash position composition and not, I'm just fucking hodling shit. No, it's your cash position. If you need to sell something, to buy something, to pay a bill, you have cash. That cash is volatile. And why would you hold a volatile asset in a cash position? Because you're alleviating counterparty risk. If shit hits the fan, you could cross a border and you have cash. Someone's going to buy it. You're going to be able to finance purchases, and that's meaningful. That's meaningful even though the price point is volatile. So you're paying a premium paid in volatility for that luxury of alleviating counterparty risk. Luxury. So maybe that's a perspective that I come from when I talk about these things. All right, this particular part of the cash position, I'm expecting it to depreciate. That sounds pretty, luxurious, and I don't want to come off as entitled, but I don't mind it depreciating, considering the benefit I get from it paying the volatility premium for the alleviation of the counterparty risk. And I could afford the depreciation. Therefore, I continue to have cash position in this type of composition. Just it's hard. It's a hard game, especially. I was talking to a friend of the family, 26 years old, yesterday, and obviously I was talking the way I talk about what is money and what are these assets, And it was like, what the fuck is this guy talking about? But he appreciated it because he was like, I've never heard anyone talk like this. And he came at me with the 26-year-old mentality. You know, digital assets are the future. What does that mean? Why are they the future? Why are they significant? And obviously, I get very deep with those types of conversations. Not just, oh, I'm trading, and that's what he said. And there's so much more to this than just making that portfolio number go up via trading, which is PVP, player versus player, which is that biological type conversation we've talked about, which means you're taking money from other people, which isn't a bad thing. It's Darwin, survival of the fittest. And when I talk about those things to him, he was very like, whoa, it's a much bigger story than what he thought it was. And that's that story we tell in this stream. Why there's much more to the story. It's not as simple as most people portray it. It's not as simple as price points. So I guess, have your runway. Make sure you have a capacity to survive. Runway makes you survive. And I'll end this stream the way I've been talking lately is, I don't know, when this shit bottoms, I want front row seat. When $9 trillion worth, $9+ trillion worth of fresh on the run collateral starts to print dollars offshore sometime towards the end of 2024. I don't give a fuck what the prices are. I want front row seats because $9 trillion into the global system of collateral, how much leverage is placed on those to print dollars? Woo! Oh man, that gets me excited. And in the meantime, we watch the DXY to see current conditions. We know various paths that could play out. We inspect current conditions to provide confluence to which path is more likely to play out and what paths play out over what time horizons. And this, to me, this screams over the next 15 years. We have lower highs and lower lows from an international FX standpoint of the dollar versus foreign currencies. That's it. Raul, thank you. Hello. Brian, afternoon cap. Much a pleasure. Juan, hey, how important is the metric TVL volume indicator indicating the efficiency of trades on your valuation of a protocol? Right now, not meaningful at all to me. Uh, value. I don't think you could have like traditional valuations of a protocol because the potential valuation is so forward-looking in these high volatile assets. You're talking about a very different valuation model. Earnings are not stable. Liquidity is microscopic. So it's not like traditional value investing methodology applied to the equities markets, like New York Stock Exchange, NASDAQ, so on and so forth, S&P, like price to earnings. I don't think they're applicable. So that's why I've talked about metrics and inspection with regard to like total liquidity and flows. There's what, 60 and change $billion in I'm zooming everywhere. 60 and change $billion, $66 billion in Ethereum mainnet, which is the largest network with regard to liquidity. Still negative sum game, but that's basically zero. So the conversation over a reasonable time horizon, the next, let's say, 4 years, why would flows occur? And that's because of friction arbitrage as well as regulatory arbitrage and the need to access financial services that are not necessarily available in a particular geographic location. Credit's permissionless in the crypto markets, permissionless. And that's risk arbitrage and potentially even regulatory arbitrage. So my inspection of protocols is really survival because I believe that basically anything that survives this draining liquidity environment is going to have such a lindiness factor heading into 2030. It's going to be remarkable. It'll be seen as infrastructure. Because when people talk about valuations on current protocols, most people weren't around in 16 and 17 to experience 18 and 19. And what survived in 18 and 19? Nothing survived. Nothing survived in 18 and 19. There was no market. There was nothing. You didn't even have a glimmer. There was no indication that this was going to occur in 20 and 21. It wasn't even hinted at. So the fact that this total amount of liquidity is present here in this emerging market is absolutely extraordinary. It's just, it indicates that there is sticky capital. Why? Why is there sticky capital compared to 18 and 19? In 18 and 19, there was centralized exchanges and speculation on price points. So, of course, when you sell for dollars, the dollars went off the centralized exchange because capital flows from underperformance to outperformance. If there's nothing to do in a depreciating market, why the hell are you going to keep dollars and stablecoins on a centralized exchange? It means nothing. You're going to deploy it to other assets that are outperforming. So if other assets and other asset classes and other jurisdictions around the world are outperforming, why is there $66.788 billion in this emerging market? That's what tweaks my fancy. It's not the depreciation that I'm looking at. It's that there's money here that's not zero. That's crazy to me. What's your thoughts on PID-controlled systems similar to money market, setter, and RAI, and their effectiveness in system control compared to the last resort mechanisms like global settlement? Well, it's going to be subjectively consumed, and that's what I've always said about development as well. Like I remember years ago, I was like, this was years ago. It's like one day you're going to interact with an SDK that finds the blockchain that is most suitable to your enterprise needs. Because you're writing a website in like React or an app in like Swift or Kotlin, you need an SDK, and you need data storage, you need transactions. I don't know, but you don't want to interact with any one particular protocol. So you interact with an SDK that finds the optimal protocol to do what you want to do. So my sentiment with regard to basically what you're saying generally is it's going to depend on what a business wants to do. So all of this, everything that you're experiencing, anything that survives is a set of tools. And anything that survives for a reason, because people and enterprise are continuing to consume it. So you'll only know what is better is better. Better is subjective, and that's what I mean. Probably better depends on the person and enterprise consuming the protocol. So we'll see. It's very hard to get a sense from a $66.788 billion liquidity environment what is the most popular, what is going to be the most consumed protocol. It's a microscopic liquidity environment. So eyes on what survives, because that's what's different this time. People say that phrase, and I really mean that phrase. It's very different this time. Nothing survived in 18 and 19. There was nothing. There was no purpose. There was no significance. There was no financial products and utilities and tools from a financial perspective that companies and businesses need. And there's a reason now, because credit and friction arbitrage and regulatory arbitrage, that's why this capital is sticky. To get away from the bullshit of a respective jurisdiction. To engage with a market that has different rules. Rules arbitrage. It's more general than regulatory and so on and so forth. While also considering governance strategies that balance system immutability and flexibility. Well, with regard to system immutability and flexibility, I must admit that anything that has mutability and flexibility, I don't engage with. I'm very fond of immutable, even considering that implies inflexibility. Liquidity. Oh my God, is liquidity going to survive? It can't be destroyed. Liquidity has nothing to do, there's no way for it to be destroyed. It will exist in future cycles. So anything that's based on liquidity, EBTC, tapioca, has overtones of liquidity. I mean, how's CRVUSD not going to see the next cycle when there's $200 billion, $500 billion of liquidity going around? How does an immutable system not survive is what I continue to think about, and that's different than 18 and 19. There was no immutable systems. There was no credit systems. There was none of this. It didn't exist. So now it exists. And that makes me very excited. So in the short term, probably very much continue to be talking about this chart. Let's zoom in on the weekly real quick. So the scary thing is that damn 50 on the weekly. Was this breach to the upside, a breakout, and a retest? Woo! Uh-oh. Because there is very little resistance above head. You literally have the TWAP on the monthly, which it smacked as well. So if we see a breakdown, we need to see a push below the 100 SMA, because we only had one push below the 100 SMA all year in July. And we've had 2 months. We've been sitting on our hands looking for data. We've had 2 months of higher, low, higher, high on the dollar. Imagine the patience and the time horizon you must have to sit through that kind of appreciation on the dollar. Painful. 2 months. You know what that does to international liquidity conditions? I've told you guys I look to this chart in many regards for purchasing power of international fiat currencies. I mean, it's a great proxy in that regard, generally speaking. Obviously, euro and yen very specifically, but that has knock-on effects to every other currency. So, thank you all for joining me. I appreciate your time. 17 people made it to the end of the stream. 13 likes. Hit that thumbs up button. I appreciate all of you. Tell everyone to subscribe. We'll survive this and keep telling stories for the entire cycle. In the description is the link to the most rational community in the entire crypto space. I will see you guys again later this week.